This spreadsheet is actually in the tutorial. I'm going to show you how to work through the spreadsheet in Excel and also demonstrate how to calculate all the different capital budgeting tools that we've learned previously in Excel. So let's get started with the tutorial here. This is the problem. You're interested in the purchase of a machine that costs $65,000. Installation of the machine will cost an additional $15,000. The machine has an economic life of 4 years with the 3 years MACRS depreciation. However, you expect to sell it after 3 years at a salvage value of $23,000. The machine requires an initial increase in working capital of $20,000. While in operation, the machine will generate $40,000 in revenues and will cost $5,000 to operate in the first year. The expected rate of inflation is 2.5%. Revenues, operating cost, and the required net working capital will increase by the rate of inflation for years 2 and 3. So year 1 is $40,000 in revenues, $5,000 in costs, $20,000 in net working capital. We're going to increase those by 2.5% in years 2 and 3. If the corporate tax rate is 40% and the firm's weighted average cost of capital is 12%, should the firm invest in the project? So that's our problem. Now I'm going to work through the solution. So the way we define the project cash flows, this is the project operating cash flow minus the project change in net working capital minus the project capital spending. The project capital spending, the depreciable basis of the investment into the machine includes both the cost of the machine and installation costs. So you get to depreciate not only the machine itself, but any kind of installation costs and transportation costs that come with putting that machine in place. And so this is reflected in the worksheet as an investment at year 0. So I'm going to go over here to the spreadsheet, and at time 0, or year 0, I'm going to put in negative $80,000. And then it says the project change in net working capital. The investment in working capital reflects an expected permanent increase in net working capital for the duration of the project. So in this case, we're buying a machine to produce goods. In order to produce goods from that machine, we have to have inventory. So there's going to be a permanent increase in inventory that lasts for the life of the project. And then at the end of the project, we actually wind down that inventory. We stop buying new inventory when we get close to or new raw materials when we get close to the end of the project, and just use up what's left and reclaim our investment. And I'll demonstrate how to do that later on. So I'm going to go over here. Our net working capital investment is $20,000, and that also occurs at time 0 because the day we get started, we want to have that inventory in place. Project operating cash flows. Since the purpose of calculating cash flows of the project is to determine if the firm's investors would receive an adequate return, we want to calculate the free cash flows that would be available to all of the firm's investors. So the term free cash flows means that these are the cash flows left after we paid off all the operating expenses of the firm. We paid for our inventory, we paid for our employees to work, we paid for the utilities, and everything that's left over in terms of cash is now available to pay out to the firm's investors. This does not include paying out money for interest expense because the bondholders are investors to the company. So we don't include financing costs, meaning interest expense, in our calculation. Instead, we discount the cash flows back at the weighted average cost of capital, which is constructed using the financing cost. So our operating cash flow is equal to the earnings before interest and taxes plus depreciation minus the taxes. Depreciation expense for each year is calculated from the MACRS schedule, and that stands for Modified Accelerated Cost Recovery System. So it's accelerated depreciation. And I put the table from the IRS website here for the half-year convention, and the half-year convention works like this. And this is from the IRS website. The half-year convention. Under this convention, you treat all property placed in service or disposed of during a tax period as placed in service or disposed of at the midpoint in the year. So we assume that any time we purchase a fixed asset, it's purchased in the middle of the year, so we take at the beginning a half a year of depreciation, and at the end we have a half a year of depreciation. Now the MACRS half-year convention table assumes that it's placed in the middle of the year, so we don't have to adjust it there. Where we adjust it is at the end. So let's say we have in our case, a project that lasts 3 years. It has a 3-year depreciation life, but you'll see here that it goes out for 4 years. That's because we have a half year here at year 1. We have a half year at year 4. For a 5-year project, we have a half year at year 1 and a half year at year 4. At year 6, sorry. For 7-year, half year at the beginning, half year at the end. That's why there's always an additional year on these, because we're assuming that we're putting the asset in place in the middle of the year. So we'll use this schedule. The end of project cash flows. The final cash flows from the project come from the sale of the fixed asset investment and unwinding the investment in working capital. There are 2 effects on cash flows from the sale of the equipment. The first is the cash received on the sale, and the second is the tax paid on the gain from sale. The gain on sale of equipment is calculated at the sale price of the equipment minus the remaining basis value. So that's a key word there. The basis value is how we normally refer to as the book value, but because we're dealing with tax statements, for tax purposes, we don't refer to it as book value. We refer to it as the basis value, and that's how we tell the difference between what's on the books, the financial statements of the firm, what you and I see as investors, and what the firm is actually reporting to the IRS. The reason why we're interested in what they're reporting to the IRS, or what we assume they're reporting to the IRS, is because that's what they're actually paying cash taxes on. And so we're interested in cash flows here because that's going to determine how much value it's creating for the company. So the remaining basis value of the equipment is calculated as the original amount paid less the accumulated depreciation expense. So we'll work through that here in a minute. Figure 3 shows the calculation for the sample problem. So let's go to our spreadsheet. What we're going to do now is we're going to put in the project operating cash flows, and then we're going to put in, to this point, the end of project cash flows. We're going to work through figure 3 here after we get our project cash flows in. So our revenues for the first year are $40,000. Our working capital investment stays the same. There's no change in it. Our operating expenses for the first year are $5,000. Our depreciation, what I'm going to do here is actually put in our depreciation percentages on the spreadsheet. So I'm going to go back here, and this has a 3-year life. If you read the introduction again, we have 33.33, 44.45. So I'll put those in right down here. 0.3333, 0.4445, 0.1481, and 7.41%. I'll make these look a little nicer. So these are my depreciation rates. So my depreciation for the year is equal to the fixed asset investment, and that asset investment alone, not the working capital investment, multiplied by, I'm going to go back here. I'm going to press F4, and that's going to lock that in place. That's going to make life a little bit easier. I'm going to multiply it by the depreciation rate for the first year, C30. And then I'm just going to drag this over so I don't have to put that in again. I can drag it over for the first year. And then for the second year, so that's the 80,000 multiplied by the 44.45. For the third year, because of the half-year convention, I need to multiply this by 0.5 because I'm only depreciating it for half a year. If we went out to year 4, to the end of the life of the asset for depreciation reasons, we wouldn't multiply it by 0.5 because the schedule is already taking that into account. Our rate of inflation is 2.5%, so I'm going to make a cell up here. It says inflation rate And I'm going to put 2.5% here. I'll make that into a percentage. And here's a nice trick in Excel if you're not familiar with it. You can name cells. So I'm going to name this one. So I selected cell F7, and then I go up here to the name box, and I'm going to name this one inflation. So I can actually just type in the word inflation, and it's going to give me that rate. So I put in equals the previous year's revenues multiplied by 1 plus the rate of inflation here. And it gives me that, 41,000. Then I go out another year, and I'm going to pull that over. It's going to do the same thing. It's got the previous year D15 multiplied by 1 plus the rate of inflation. I'm going to make these look better. There we go. My operating expense should actually be negative. So we put negative there. I'm going to do the same thing with the rate of inflation is equal to the previous year multiplied by 1 plus inflation. I'm going to pull that over again. And so I've got my revenues, I've got my operating expenses, I've got my depreciation expense. My working capital investment expense is also going to increase by the rate of inflation. So my change in working capital is the amount of additional working capital I have to invest in for each year. And it makes sense that this should go up because the cost of goods sold per unit that we sell for every piece of inventory we bring in is going to also increase by the rate of inflation. Our sales are increasing by the rate of inflation, so our accounts receivable should also increase by the rate of inflation. So our change in working capital investment, in year one, we're not going to put an increase. In year two, we'll increase it by the rate of inflation. So up here, I'm going to put in equals the previous year's working capital investment multiplied by 1 plus inflation. So it goes up by $500. And then I'm going to pull this over one more year, and it's going to increase by $512.50. So what I'm going to put down here is that this represents a cash flow. We're going to put more money out. We're going to increase our inventory expense. So I'm going to put in here equals the change in the working capital investment. See, it's negative. It's going to be a use of cash. I'm going to do the same thing for year three. So our cash flow isn't the $20,500. It's actually just the difference. It's the change from one year to the next. Our earnings before interest and taxes. So our earnings before interest and taxes do not include the change in the working capital investment. The reason being is that this is not tax deductible. So our EBIT is equal to 40,000 minus the 5,000 minus the 2664. So I get 8,336 for year one. For year two, I get $315, and then for year three, I get $30,847.88. My tax rate, according to the problem, is 40% if the corporate tax rate is 40%, so I'm going to put that in here. I'm going to make that negative because that's going to be an expense. And then we add back depreciation. So I'm going to put equals negative and then highlight the depreciation expense. So the reason we did that, the reason why we take out depreciation then add it back in is because depreciation is a non-cash expense. So we get to take it out, and we like to take it out because it decreases our taxable income. So we take it out so we're not taxed on it, and then we add it back in because it wasn't really a cash expense. However, tax is a cash expense. We actually have to pay that. And so it's beneficial for firms To do this, to have depreciation, take it out and add it back in afterwards, because this is a non-cash expense, but it affects our cash because we reduce our taxable income by that amount. So after we add back depreciation, we calculate our operating cash flows as our change in working capital plus the EBIT. Subtract out the tax, but it's negative on here, so we use a plus sign, plus the depreciation. So change in working capital investment plus EBIT plus tax plus the adding back depreciation. And for year 1, we get a cash flow of $31,665. For year 2, we get a cash flow of $35,249. And in year 3, we get a cash flow of $23,920.23. So the next step is to determine what the cash from the sale of the equipment is. So going back to the tutorial, it says here, the end of project cash flows, the final cash flows from the project come from the sale of the fixed asset investment and unwinding the investment in working capital. There are 2 effects on cash flows from the sale of the equipment. The first is the cash received on the sale. So in our case, we expect to sell it for $23,000. And the second is the tax paid on the gain from the sale. So I want to make it clear here, you're not paying tax on the sale amount, you're paying tax on the gain on the sale. The gain on sale of equipment is calculated as the sales price or the sale price of the equipment minus the remaining book value of the equipment. The remaining basis value of the equipment. The remaining basis value of the equipment is calculated as the original amount paid less the accumulated depreciation expense. Figure 3 shows the calculation for the sample problem. So we're going to calculate this, but we're going to do it in Excel to make it a little easier. So I'm going to go up here to the top. Our fixed asset investment was the $80,000. So that was our basis value. And now we put in our depreciation for each year. So for year 1, it was $26,664. For year 2, it was $35,560. And for year 3, it was $5,924. So here our accumulated depreciation, I'm going to put in equals the sum of these 3. And if you're thinking of like a balance sheet, and this helps me out, I think of the gross fixed asset value of $80,000. The accumulated depreciation value would then be $68,148. And then the net fixed asset value would be the remaining value after we take out the accumulated depreciation. So $11,852. So the gain on the sale of the investment is equal to what we sell it for, $23,000, minus the remaining basis value. So the gain on the sale of investment is $11,148. The tax on the gain is our tax rate of 40%, minus the gain on the sale. So our tax is $4,459.20. And again, I'm not taxing the $23,000 I'm receiving. I'm taxing the gain on the sale of the investment. What I'm receiving that is above the book value or the basis value of that equipment. So the cash flow from the sale of the equipment, there's 2 pieces to it. What we sell it for, and we expect to sell the equipment for $23,000 minus our tax on the gain of $4,459.20. So our cash flow from the sale of the equipment is expected to be $18,540.80. So our cash from the sale of the equipment is equal to $18,540.80. And then at the end of the project, our recovery of the working capital investment. So what happens here, and let me go back to the tutorial. The gain on the sale of the investment, I've already put these in here, and I'm going to show them again to you. So the gain on the sale is the $23,000 minus the taxes we paid. So it's $11,148. So that's our gain on the sale. And the tax on the gain is $4,459.20. So the cash flow from the sale of the equipment would be our $23,000, which is what we receive, less the amount we paid out, which was the $4,459.20. And so that's equal to $18,540.80. The second end of project cash flow is recovering the working capital investment. Throughout the project, a level of investment remains in net working capital that is unwound in the final year as the last pieces of inventory are converted to sales and accounts receivable are paid and no new investment into working capital takes place. So imagine that you're near the end of the project and you're probably in the last 3 months of the project. You've got enough inventory, raw materials inventory on the shelf to make new products for the next 3 months. So you're not planning on buying any additional inventory. So unwinding the investment takes place in this way that we use up that inventory on the shelf. We don't reinvest and we receive the cash back without reinvesting it when we sell the product. Additionally, when we look at accounts receivable, it's the same idea. We're selling things on credit, and when we're done at the end of the project, we're not selling any more of the product on credit, so we're not increasing, or we're not even maintaining the amount of accounts receivable from the project. We're winding them down. We're collecting the cash from the accounts receivable without generating any new accounts receivable. So we're decreasing our inventory, we're decreasing our accounts receivable, and as we do that, we get cash in its place. Okay, so we're unwinding the investment and we're collecting the cash we have invested in the working capital. So the way this works on our project cash flows, if I go down here, the recovery of the working capital investment, that's going to be equal to, I'm going to be equals negative the working capital investment just for that last year, because this is just accumulating every year. We're not investing $20,000 in year one and then $20,500 in year two. We're only investing $500 in year two and an additional $512.50 in year three. So we're getting all that cash we have invested in inventory and accounts receivable back at the end of year three. So in the end, our project cash flows look like this. At time zero or year zero, we receive $100,000, or we invest $100,000. At year one, our operating cash flows are $31,665.60. Year two, they're $35,249, and that also includes the investment we have up here in the working capital. And then in year three, we have our operating cash flows of $23,920.23, plus the cash from the sale of the equipment, plus the recovery of the working capital investment. So this is what our cash flows look like. You want to make it look like something you've seen before, we can copy it. We can put it in this order. So I have my cash flow, and I have my year. And that's what we were doing in the previous chapter. So now we're going to calculate the NPV, the IRR, the MIRR, the profitability index, and the payback period. NPV is a little bit different in Excel because we don't want to include the time zero cash flow or the year zero cash flow in the NPV function. So here I'm going to put equals and then the negative 100,000 plus NPV. The discount rate is the weighted average cost of capital. So in this case, it's 12% from the tutorial. And then I'm going to put a comma and highlight the rest of the cash flows. So it looks like this. And the reason we don't put the $100,000 in here in the NPV function is because the first cash flow that NPV sees, it discounts back by 1 year. So it assumes that first cash flow occurs at year one, the second at year two, and the third at year three. And I get an NPV of $1,552.35. My IRR equals IRR. And I highlight all of it. And I get 13% there. Let's take it out 12.8%. My modified internal rate of return is equal to MIRR. I highlight all my cash flows again, and then it gives me two options here. The finance rate, and this is going to be your weighted average cost of capital, so it's 12%, and the reinvestment rate. This is the rate that you assume you're going to reinvest the cash inflows at. So the rate we assume we're going to reinvest the 31,665.60, the 35,249, and so on. We're also going to use the weighted average cost of capital here. And I get an MIRR of 12.58%. So the profitability index, I'm going to calculate this as the NPV, and then I'm going to add the initial investment of $100,000. And if you look at what I'm doing, I'm actually taking minus that amount because it's a negative number. And then I'm going to divide it by the negative, by a negative, and then the negative 100,000. And I get a profitability index of 1.02. So the payback period, so we just add back the cash flows. And so that's what I'm going to do here, equals my 31,660, my negative 100,000, and I'll put a plus 31,665. Well, we still have 68,334 to pay back. So I'm going to take that plus my year 2 cash flow. And now we only have 33,085 to pay back. So I'm going to divide that by my year 3 cash flow. And I get 0.5212. So my payback period is 2.52 years. Okay, so the question is, would we accept this? And it looks like we would. The NPV, while not huge, is positive, 1552.35. The IRR is greater than the weighted average cost of capital. The MIRR is as well. The profitability index is 1.02, so it's greater than 1, and we expect it to pay back in 2.52 years. All right, so that's it for this tutorial. Please let me know if you have questions about it.